Okay, welcome back, everyone. Good afternoon. My name is Tony Zhang. I am the Chief Strategist here at Options Play, and today we're going to be talking about how to trade earnings like a pro. For those of you that are brand new to Options Play, welcome. This is another one of our webinar series. I think this is a pretty interesting topic today, talking about earnings, because we're just about to launch into earnings seasons. We've certainly had a choppy few weeks with the whole rhetoric with trade wars, concerns about lots of geopolitical risks. So going into earnings seasons, it'll be interesting to take a look at how corporations are affected by it. And it really allows us to focus a bit more on corporate profits, which is really what drives equity prices. So today what we want to talk about is how you can utilize options to help you play earnings with limited risk, allow you to take bullish and bearish views on the underlying market. As we know, earnings is the largest contributor to big swings in the stock markets. So what we want to do is try to be able to capture some of those swings with limited risk using options. So today we'll talk a little bit about what are the best practices, talking a little bit about the preview of the earnings season that's coming up, and then show you how to actually trade them using Options Play. The goal here today is to make sure that not only do you understand what strategies to trade on earnings, but more importantly, how to evaluate your strategies so that you can decide whether it's best suited for your portfolio or not. Trading earnings does involve a high amount of risk. It also can potentially mean a high amount of reward. So we want to make sure we show you the best practices to be able to efficiently take advantage of a bullish or bearish move on the underlying stock. So today, what we're going to talk about is an earnings season preview to help kick off the earnings season, give you an idea as far as what happened last season, give you an idea as far as what we're expecting going into the next earnings season. Then we'll talk a little bit about what trading earnings actually means, why you should consider trading it, and most importantly, how can you trade earnings effectively. We'll spend about 15 minutes using the slides, going through some concepts for those of you that are relatively new to trading options or trading earnings. And then what I want to spend the bulk of the time is actually showing you real examples of stocks that are reporting earnings in the next few weeks and showing you how to analyze them, both bullish and bearish views, so that you can decide whether this is suitable for you and then become self-sufficient in being able to look at these types of analysis on your own. Now, before I get started, I just want to do a quick check of people in the room. If you have traded earnings before, whether you trade stocks or trade options on those earnings, can you please type yes into the chat window? And if you're brand new to options trading, please type no. Okay, so I got a pretty much, I would say, half-half here. I got a lot of people who have said yes, but plenty of people who have also said no. So for those of you that are brand new to options trading, or I'm sorry, if you're brand new to trading earnings, welcome. It's certainly potentially a very exciting time for those of you that have never done it before. It does potentially have a high amount of risk. So we really want to show you how to limit your risk when you're trading earnings. So let's jump right into what are expectations for earnings, and then we'll come back. I have a few other questions for those of you that are brand new. So we're just going into Q3, which means that we're starting to go. We're going to get companies to report their Q2 earnings. So let's take a look at what actually happened in Q1. So Q1 was one of the strongest quarters in the history of the S&P 500 for both sales and earnings per share. This is really because we've had a relatively strong economy. Corporate profits are at all-time highs. Corporate revenues are at all-time highs, which is certainly what we typically look for higher equity prices. And it was impacted by the fact that in late 2017, we passed a major tax reform bill and the impact of that was that we saw the S&P 500 effective tax rate go from 25% down to 19%. So a 6% reduction in the effective tax rate on S&P 500 stocks. That's a big amount to be reduce a company's tax bills by, and that's a lot of money for these companies to be able to utilize in different ways. And we see companies utilize them in capital expenditure and R&D and mergers and acquisition to grow their business. And then we primarily saw most companies actually use that money for share buybacks and return capital to shareholders through dividends. So what we do here with, however, I think the biggest headline for Q1, that's I think the most important one to keep an eye out on, is the fact that despite one of the strongest quarters in the history of the S&P 500, the stocks that actually beat or at least met their expectations had relatively muted results, meaning the stocks didn't really move much higher after they beat their earnings. However, stocks that missed their earnings typically had a huge negative reaction. And this type of reaction to earnings is very common in what we consider late cycle bull markets. So we've been in a bull market for almost 10 years. And usually bull markets this long tend to have a higher risk of a correction. And so right now what we're seeing is this late cycle reaction where stocks that are outperforming are not really, stocks that are beating their earnings estimates are not really outperforming, but stocks that are missing their earnings estimates are certainly being punished significantly to the downside, to the tune of about 2 to 1. So this is a major headline for us to be aware of going into Q2, because we expect similar type risk to reward on stocks that beat versus stocks that miss. So taking a look at Q2, what are our expectations? Same thing. We're expecting a very strong quarter for both sales and earnings per share. This is from companies' guidance that they've provided us to give us an idea as far as where they feel that the markets are. The tax reform is going to be another big piece. What we see is that there's certainly companies that have increased their capital expenditure, increased their share buybacks, increased their dividends because they have this extra cash from that tax reform. However, what's similar type price action here, the stocks that have actually had the largest buybacks in Q1 did not actually outperform the stocks that had normal buybacks. So that's actually something also to consider. And one of the things that I think we need to look out for is companies' guidance. That's likely going to provide the direction as to where the stocks will trade after earnings, less so than the actual earning reports themselves. So that's some of the themes that we see in Q1 and what we're expecting to see in Q2 is really just a relatively muted quarter for positive stocks, but a relatively big quarter for stocks that miss their earnings or sales estimates. So taking a look at what sectors scan best for Q2. So stocks that had the highest upward revisions or better company guidance on both sales and earnings per share. We saw that in the healthcare, technology, and materials space. And on the downside, and specifically for healthcare and technology has certainly been a strong sector for quite some time now, and we expect that to continue. However, technology does seem quite late in the cycle, so I think there are more downside risks to technology than there are upside potential rewards. Healthcare is a sector that recently really just turned around over the last month or so, and I actually expect that sector to probably be a little stronger on the stocks that do beat on earnings. And lastly, materials, also another sector that recently turned around only in the last month or so. So we expect healthcare and materials to potentially have higher potential upward rewards, and technology potentially some downside risks. On the downside, we see sectors like utilities and consumer staples and telecommunications have downward revisions. Utilities is a very interest rate sensitive sector, so as interest rates rise, this sector looks less and less attractive. Consumer staples has just been a terrible sector for quite some time now, and we actually expect that to continue. And telecommunications also, same thing, has been a sector that has really lagged behind the overall market, and we expect that to continue going into Q2. So with that, what I really want to talk about for those of you that are brand new to trading earnings, and if you've never traded this before, I just want to do a quick overview of that. So what are earnings? Earnings is very simple. It's when a company reports their revenues, their profits, and provides forward guidance as to where they think the markets are headed for their specific company. Now, when companies report their revenues and profits, this is when the markets gets revealed the information about what happened in the previous quarter. And what this provides is that it creates a binary event where the market all of a sudden is released new information, the market reacts to this. When the stock beats their earnings estimates, the stock tends to trade higher. When the stock misses their earnings estimates, they tend to trade lower. So what this creates is a binary tradable event with extreme volatility. And this extreme volatility provides opportunity. It also provides risk, which is why it's really important that today's context is not only talking about the potential opportunities that earnings provides, but more importantly, how to limit your risks or limit your downside when you're taking these types of trades. So lastly, how do you actually limit your risk when you're trading earnings? And the best way to do that is actually utilizing options. Now, for those of you that have traded earnings before, how many of you use stocks to trade earnings and how many of you use options to trade earnings? Please type them into the chat window. I'm interested in understanding kind of, do you buy the stock if you think it's going to beat, or do you buy an option if you think a stock's going to beat? I'm very interested in understanding kind of what people use. And while people are answering that, I'm going to explain, in terms of using options, why we want to consider using options for this type of strategy. It's because options, you can buy a call or a put to allow you to take either a bullish or bearish view on an earnings, but it also provides you with limited risk. So even if the stock goes to zero or if the stock goes to infinity, you have limited risk to the amount of money you've paid on that option. So when you're buying a call or a put for an earnings play, you usually want to choose expirations that are roughly at least 2 weeks beyond the earnings date. And the reason for this is because a lot of the follow through of a move in earnings happens a few days to a few weeks after the earnings announcement. So you may have a stock that beats on earnings and it gaps higher, but it might continue going higher for another 5 days or 10 days. So that's why, in order to capture all of that movement, you want to have an expiration date that's at least 2 weeks beyond the earnings date. I usually tell people to go even a little further than that. 3 to 4 weeks. However, the absolute minimum should be roughly 2 weeks. And lastly, like I said, you can buy a call or a put option to speculate on direction. Well, we will look at buying some put verticals and call verticals as well to help you guys compare. But usually, most people like to just buy calls and puts for an easy analytics going into earnings. So looks like a lot of you use options for your earnings play. Some of you use stocks, some of you use both, but looks like the majority of you use options, which is great. And again, this is the reason why we're doing this webinar, because options provide you that upside or downside exposure, but it provides you with limited risk if you're absolutely wrong on this specific trade. So let's talk a little bit about how do you make money from earnings. It's actually quite simple, or I shouldn't say simple. It's actually quite risky. And the reason for this is because when you're trading earnings, there's really 3 factors that you're mostly concerned about. You have the large stock move that's going to either work in your favor or against you. So this is usually contributed to if a stock beats or misses their earnings announcement. That large stock move contributes to either a gain or a loss in your options. The second factor that you need to consider is volatility crush. Now, what volatility crush means is that the implied volatility of an option will actually decrease right after the announcement. And the reason for this is because before the announcement, there's a lot of uncertainty as to where the earnings are going to be. And what that implies is a large uncertainty factor. So the option market prices in this large uncertainty factor with a higher implied vol. And once the earnings comes out, that uncertainty goes away. So the volatility comes lower. So because that volatility comes lower, it actually decreases the price of the option that you own. So you're actually losing value in the option as the earnings comes out. Even if the stock doesn't move anywhere, the option price will decrease in value right after earnings. So that's going to work against you when you're buying an option. And lastly, you have time decay. Time decay is always going to work against you regardless what. It doesn't matter if you're trading earnings or not. Time decay is always going to work against you when you're buying an option. So these are the three factors that you need to be aware of going into earnings. So how do you actually profit from earnings? It's actually a pretty simple formula. It simply means that the stock move needs to be large enough. You need to have a large enough move in the underlying stock that provides you with a large enough gain on the option to overcome the losses that you have from volatility crush and time decay. So volatility crush and time decay is working against you. That's the amount of money that you're losing. You must offset that with a large move in the underlying stock to offset the losses that you have in volatility crush and time decay. So really simple formula, not very difficult to understand. However, that brings up the question, how do I calculate what I'm going to make on the option from the large move? How do I calculate how much money I'm losing to volatility crush? How do I calculate how much time am I going to lose to time decay? So that brings us to the next slide. Now, this is the slide that tends to confuse some people. This is the slide that people tend to get a little weirded out with all the math and the numbers and the Greeks. But I want to point out before I start talking about the slide that I'm showing you these slides for more of a conceptual use so that you understand this on a high level. The great thing about options play is that we do all of these calculations for you so that you don't have to know how to do them yourself. But I do want to put the slide up so that you have an idea of conceptually how this works, okay? And the slides that I'm showing you right now, I will include in the recording after we send out to everyone so that you guys have access to these slides. That are, if you want to go over these slides or if you want to review the video, you can do that right after we finish here today. So how many of you are familiar with the Greeks? If you are, type yes into the chat window. If you're brand new to the Greeks or you don't understand the Greeks, type no. Because the Greeks can be quite daunting and it's not something that everyone feels comfortable with. So, most of you said yes, but quite a few of you also said no. So for those of you that are brand new to Greeks, it can be daunting, but what I want to do is help simplify everything for you. So we talked about three things. We talked about a large stock move working in your favor. We talked about volatility crush, and then we talked about time decay. So how do we measure each one of these three? And that's what delta, vega, and theta tells us. So delta tells us the change in the price of the stock, the change in the price of the option with respect to the change in the price of the stock. So this tells me how much money am I going to make on the option for every dollar that the stock moves. So if you have a call option with a delta of 0.5, that means for every dollar that the stock moves higher, your call option is going to increase in value by half that, 50 cents. Okay, so that allows you to quickly estimate roughly how much money am I going to make on the option if the stock moves in my favor. So this is that large move factor that we're talking about. So if you expect the stock to move $5 and you have a delta of 0.5, that means you should make roughly $2.50 on that option. Next, we talked about volatility crush, volatility working against us. That's what Vega tells us. Vega tells us the change in the price of the option price with respect to volatility. So if you have a call option that's got a Vega of 0.25, that means that the option will lose 25 cents for every 1% the volatility comes down by. So if volatility is going to come down by 4%, you're going to lose $1 on the option due to volatility crush. And lastly, theta tells you how much the change in the price of the option with respect to time. So if you have a call option with a theta of 0.1, that means this option will actually lose 10 cents in value per day that goes on. So this allows you to now measure accurately or fairly accurately what your expected gains are or losses if the stock moves in your direction or against you. Vega allows you to measure exactly how much you should expect to lose or gain based on changes in volatility. And lastly, theta tells you how much you lose or gain based on time that goes by. So with these three numbers, you're able to estimate roughly how much money you're going to make on the option versus how much money you're going to lose to volatility and theta. So usually at this point, people will ask me, where do I find delta, and how do I do these calculations myself? And that's really the beauty of options plays, that not only do you not have to find it, you also don't even have to calculate it, because we automatically do that for you. And the whole point of this webinar is to show you how we do that, so that you can quickly analyze any strategy and be able to intelligently decide which strategy is best suited for you and whether or not you should be trading earnings on a specific stock. So now that we've covered that, I'm just going to cover the two basic strategies that I think we should all be aware of going into earnings. So the first strategy I'm going to talk about is buying a call or a put. This is the simplest of option strategies for going into earnings. You buy a call if you're bullish on the stock. You buy a put if you're bearish on the stock, or if you expect a miss on the stock. These strategies provide you with unlimited profit potential, just like buying the stock or shorting the stock. However, this is a strategy that you typically use when you expect a big move in the underlying stock. So typically, it's stocks that are relatively more volatile. Things like technology stocks, biotech stocks, pharmaceutical stocks. These are the types of stocks that typically see some of the larger jumps on earnings. These are the type of stocks that you typically may want to buy a call or a put on. This strategy does have larger amount of money at risk. So be aware of that. Even though there's limited risk in these strategies, when you're buying a call or a put, you are generally risking a larger amount of money at risk compared to some other strategies. The second strategy you can consider when you're using options to trade earnings is a call vertical or a put vertical. A call vertical for if you expect a beat on earnings, a put vertical if you expect a miss on earnings. This strategy provides limited profit potential. So unlike the call or a put where you have unlimited profit potential, this has limited profit potential. Now, this is really useful if you expect a more modest or a slower move on earnings. Sometimes you might not even expect the move on earnings. Maybe you just expect the move to happen after earnings. These tend to be more for the blue chip stocks, or stocks that may not move as much, like Procter & Gamble and IBM. These types of stocks that are large blue chip stocks that simply don't have large gaps going into earnings. They tend to, for the most part, come in line with earnings, and the moves that happen after earnings tend to be relatively smaller and more modest. So using a put or a call vertical tends to be a little better for these types of stocks. And you typically put a smaller amount of money at risk. So we're actually going to compare that call to a call vertical, and we're going to compare a put to a put vertical in the examples that I'm going to show you here today. And lastly, regardless of which one of these strategies you use, the best thing to do is pick expirations that are anywhere from 1 to 2 weeks beyond the earnings date. Again, you want to be able to capture any movements that happen after earnings. Many times stocks will move in the direction that they gap in for 2, 3, 5, sometimes even 10 days. So you want to make sure you have the option expirations that allow you to capture that. So with that, what I want to do is I want to actually show you some real examples of stocks that have earnings coming up in the next few weeks, and show you how you can use the P&L simulator to actually analyze these strategies so that you can decide whether these types of strategies is best suited for you and for your specific stock that you're looking at. So I'm going to start off with Facebook, just because this is a relatively popular stock. Everyone knows who Facebook is. I think many of you are probably even familiar with trading the stock on earnings. It's probably one of the more popular ones and covered more likely in the news. So let's take a look at Facebook. Facebook, as you can see, reports earnings here on August 1st, which is roughly 20 days from here. Now, this platform, Options Play, for those of you that are brand new, welcome. This tool is designed to help make your options trading as easy as possible. We designed this to facilitate exploring, analyzing, and ultimately trading of options. But the biggest difference that we created was that normally if you're trading an option, you're used to looking at a page that looks something like this, where you have a list of all your strikes, all your expirations, and just simply provides you with a lot of numbers. Now, the good thing about this type of page is that you see all the possibilities all at once. However, the downside is that you don't get a lot of the real analytics that you need to decide which one should I trade? So if you're bullish on a stock and you're looking at maybe the 190 calls versus the 195 calls, how do you know if the stock goes up by $10? How much money do you make? What happens if the stock goes down by $10? How much do you lose? These are very important things for people to understand before they trade. Let alone if you wanted to compare buying a call to a call spread, that's not something you can do on an option chain. So that's really why we created Options Play. We wanted to be able to show you strategies side by side and allow you to actually compare them definitively with exact profits and losses so that you can decide which one's best suited for you. And that's what I'm going to walk you guys here through today. So the platform itself is divided into 3 sections. You have trade ideas and watch lists here on the left. We have our security analysis panel here in the middle, and we have trading and income here on the right. So when we're looking at Facebook stock or any stock going into earnings, one of the things that we typically look for is what is the current trend of that stock? Is it currently trending higher? Is it trending lower? Facebook here, as you can see, the 1 month and 6 month trends are bullish. It's actually been in a bullish trend for quite some time. We also look at relative strength because stocks that have strong relative strength typically have a higher probability of beating earnings, and stocks that have low relative strength tend to have a higher probability of missing on earnings. So looking at Facebook, it's got a strong technical score. It's trending higher. This is all indications that there's a possibility that it could beat on earnings. Now, I want to point out that this is by no means a solicitation to trade Facebook. We're not saying that necessarily we're bullish on Facebook going into earnings. We're just using this for illustrative purposes to show you how you can analyze any stock on your own and decide whether this is a trade that you want to place. So looking at Facebook, it's trading at 206 right now. You have 2 options. You can either select I'm bullish and be presented with 3 bullish strategies, or you can select I'm bearish and be presented with 3 bearish strategies. So even if you disagree with us, if you think Facebook's going to miss on earnings, click on I'm bearish and we'll show you 3 strategies on how to take advantage if Facebook misses on earnings. So, but for now, we're going to look at bullish strategies. I'll come back in a few minutes and I'm going to show you guys another example of a stock that may be bearish going into earnings. So looking at Facebook, as you can see, it's currently trading at 206 right now. It actually recently made a new 52-week high, which is quite an interesting thing to see right before earnings. These are the type of strength that we like to see that are more likely to contribute to potentially beating on their earnings estimates. So let's take a look at the 3 strategies that you can deploy if you're bullish on earnings or if you expect Facebook to beat on earnings. So first of all, you can always buy the stock. That's the simplest of strategies for people to understand. Buying the stock is easy, but however, buying 100 shares of Facebook right now costs you about $20,000. Instead, you can buy this call option that costs you $915. So roughly 2% of the underlying stock you can effectively get upside exposure with limited risk, because what you pay for the option is what your risk is limited to. So if you can risk only 2% of the underlying stock, that is a significant reduction in the risk that you're taking compared to buying the stock. And that's really why I encourage, if you're trying to trade earnings, you're better off considering taking a look at an option strategy versus buying a stock. Conversely, the strategy here on the right, you can buy this vertical here for about $750. So about 1.5% of the underlying, so even less risk. So let's actually take a look at how do these strategies perform if Facebook beats beats on earnings. Now, we talked about 3 things that we need to look out for. We need to look out for the large move in the underlying stock. We also need to consider the volatility crush and the time decay. So let's take a look at each one separately. So first of all, if I'm looking at Facebook and I think it's going to beat on earnings, I may have a price target here. Now, granted, this is at a 52-week high. I don't have a clear target here or a good number to go off of. However, as you can see, this stock rallied from 193 or so to about 206 just in the last week or so. So this stock can move easily. And I think that for Facebook to move $10 or $15 higher in the next few weeks, especially if it beats on earnings, is by no means, I would say, I would not say that that's a very aggressive target. So the stock could easily hit, in my opinion, maybe 220 if it beats on earnings. Now, so what I've done is I've used our P&L simulator. This is by far the most powerful tool available to you guys, especially if you're brand new to options trading, to learn more about how to analyze these strategies. Use the P&L simulator to help you better understand how these strategies perform for any given scenario. So this is where you no longer have to find the delta, find the vega, find the theta, and actually calculate these things on your own. We do all of those calculations for you and simply just tell you what your expected results should be. So if you think the stock's going to go to 220, first of all, what we want to do is look at, instead of holding it to expiration, what if the stock moves up to 220 a few days after earnings? So we know that the earnings are on August 1st. So what happens if the stock goes up to 220, let's say 4 days after earnings on August 5th? And we know that volatility comes down after earnings. So let's assume some volatility comes down from 28% to 21%. And as you can see, now I don't have to do any calculations. I already know exactly what my expected profit and losses for each one of these strategies are. So let's see, if I bought the stock, I make about a 6% return. So certainly a nice return in a few days, but relatively small compared to the call option that I'm making a 70% return if the stock goes to 220 by August 5th, and the volatility comes down a little. Conversely, if I bought the spread here on the right, I actually make an even higher return, an 83% return. So this is really where you can use this P&L simulator and simulate different ideas and see exactly what your expected profit and loss is for any one of these strategies. And you can use the slider to kind of really play around and see at what point do these strategies break even. So as you can see, the stock needs to move to roughly 210 a few days after earnings and volatility comes down for this strategy here on the right to break even. So that's only about $4 higher, not a lot higher, or only $3 higher actually, from where it currently is trading in order for these strategies to break even. Not very much for a stock like Facebook that moves $4 or $5 in a day. So it could reach those levels tomorrow easily. So in this particular case, not only does this tool allow you to define what your expected potential reward is and potential risks if you're wrong. So if, let's say, Facebook goes down to 192, how much do I actually lose? So what if you're wrong on earnings and Facebook really kind of misses earnings, they miss their earnings target, or perhaps they provide some forward guidance that doesn't look very good? As you can see, if you had bought 100 shares of this stock, you lose $1,400 on this trade. If you bought this call option, you lose $866, a little more than half of what you would lose on the stock. But if you bought this call vertical, you lose $700. So roughly half of what you would lose if you had bought the stock. So this is where trading the option allows you to gain that same upside exposure that you get with buying the stock. But if you're wrong, you have a significantly lower risk on your strategies, especially if this stock really tanks. What happens if it goes down to 170, right? Unlikely, but what happens if it does? If you had bought this stock, you'd lose $3,600. And you would lose even more if the stock went even lower. But if you bought this call option, you're limited to this $915 loss. So as you can see, the most you'll lose here is around $915. Same thing here on the vertical. You lose $755 or $756. This is how much you paid. What you pay for that option is the most amount of money you can lose. So this tool not only allows you to model what your expected gains are, but also allow you to really play around and see how far does the stock need to move for this call option to be profitable. So here, as you can see, the stock needs to move to 212 before this call option is profitable. So this allows you to say, well, do I think Facebook's going to go to 212 or higher on earnings? If I do, then maybe I might want to trade this call, or maybe I want to trade this call vertical because it gives me a higher return. What happens if I think the stock's going to hit 250? Or 245. As you can see, if the stock goes to 245, I make a 345% return on this call versus only 193% return on this call vertical. So if you're super bullish on Facebook, you might want to trade this call instead of this call vertical. This allows you to really set up your own strategies and define which strategy is best suited for your given outlooks. You don't have to rely on us. You don't have to rely on someone else to do the analysis for you. This tool allows you to make those decisions for yourself and decide which one's best suited for you. And So if you look at all of these analysis and you decide that, hey, this call option or this call vertical is what I want to trade, you can hit the trade button. And what we have is a strategy checklist. So many of you have said that you're relatively new to options trading. You absolutely want to take your time with this the strategy checklist. Make sure you understand your risks before you place your trade. We check the stock trend. Are you trading with the trend of the market? We check the market trend. Are you trading with the trend of the market? We look at the options play score, which is our risk to reward metric to give you an idea as far as how much risk to reward you're getting on this specific trade. We look at earnings dates. So we check to see if there's earnings between now and expiration. In this particular case, we want there to be earnings. So this is good. And lastly, we look at spread and liquidity. So another thing to look out for if you've never traded options before is that when you're trading stocks, you're not as worried about liquidity, but when you're trading options, it's a much bigger concern. So what we look at is the spread between the bid and the ask price to determine how liquid is this option, to give you an idea, because you want to know those things before you get into a trade, not after when you're trying to get out. So once you've decided this is a trade that you want to make, we give you all the details on how to enter this trade into your broker's platform. So make sure that you follow this correctly when you enter them so that you don't make any mistakes when you enter this particular specific trade. So with that, what I want to do is I just want to go back. I want to look at some maybe some other examples here. I have maybe Procter & Gamble. Procter & Gamble reports earnings in just a few days, July 26th. As you can see, the 1 month and 6 months trend is bullish / neutral. The technical score is relatively weak. This is in a fairly weak sector in consumer staples. So we certainly want to take a look at potentially, different trades here. So and this is by no means a solicitation to trade Procter & Gamble. I don't even necessarily have a specific view on this specific trade. So I just want to use this as an example to say, what happens if we're bearish on Procter & Gamble going into earnings? What if we think consumer products, as you can see, it's trading right around this resistance level? I don't think it's that crazy for someone to say this is a relatively weak sector. There's a possibility that this might miss on earnings and maybe gap back down to the 75, 76 level. So let's take a look at that for argument's sake. If I click on I'm bearish, we'll now be presented with 3 bearish strategies. So let's take a look at first of all, if you don't want to trade options, you can always short the stock going into earnings if you think it's going to be bearish. I don't recommend it because you have unlimited losses if the stock shoots higher. And because there are much better options such as buying a put option. It allows you to get the same downside exposure while maintaining a limited amount of risk. Or you can always take a look at this put vertical, which might make sense depending on where you think Procter & Gamble is going to be. So, I see this 75 level as a support level on Procter & Gamble. I think that's a pretty conservative target to hit if the stock misses on earnings. So let's say we think the stock's going to go to $75 a few days after earnings, which is on July 26th. So let's say on July 29th, the stock hits $75. And we know volatility always comes down a little after earnings. So let's say we also put that into consideration. As you can see, if I shorted the stock, I make a 4.8% return. So almost a 5% return. It's a nice return in just a few days. However, if you look at buying a put, you get a 97% return if the stock misses on earnings and it goes down to $75 and you had bought this put option. Conversely, if you had bought this put vertical here, you make 111% return, even nicer, even more attractive return if you bought this put spread. And that's really because you've reduced the cost of your trade by a quarter. So here it costs you $209 to buy this put. To buy this put vertical only costs you $157. Imagine if you can reduce the cost of buying a stock by a quarter. Think about how much that would magnify your returns if the stock goes in your favor. This is really one of the benefits of trading options. It allows you to structure different options to give you different payouts. So on Procter & Gamble, I don't expect the stock to go down to 71. This is a relatively large cap stock. The economy is strong. I don't expect things to just fall under the table for Procter & Gamble, but maybe I think that it's going to miss on earnings because because consumer staples is certainly a weak sector right now. So 75 is a roughly conservative target in my opinion. This allows me to quickly see what my expected gains are, how much am I going to lose to volatility, how much I'm going to lose to time decay, and know exactly what my expected outcome would be before I get into a trade, so I know my potential rewards, and on the same token, know my potential risks. Let's say Procter & Gamble, instead of missing on earnings, actually beats earnings. And let's say it goes back up to this 84 level, which I think is a conservative target on the upside. So as you can see, if I had shorted the stock, here I lose $515. So a substantial amount of money that I'm going to lose here. If I bought this put, I lose $204. If I bought this spread here, I lose $152. So as you can see, I'm losing only a fraction, almost a third of what I'd be making. Of what I'd be losing if I had shorted the stock. Instead, if I bought this put vertical, I'm only risking a third of that amount if I was wrong. So not only do I make a substantially higher return if I'm right, but I'm actually risking a much smaller dollar amount if I'm wrong. So that's a key reason why this strategy here on the right has a higher options play score than these two strategies, because it provides a much better risk to reward for if you're correct, and a better risk reward if you're wrong. And that's really the key thing to options trading, is making sure you understand your risk to rewards and maximizing your potential rewards while minimizing your returns. And how do you quantify that? That's what the options play score tells you, is how well balanced your risk to reward is on any strategy. And we allow you to compare them side by side. And it's all color coded for you so that you don't have to memorize what's a good score, what's a bad score. Here, 71 tells you it's not a very good risk reward strategy. Yellow means okay, green means good. And I want to point out that just because it's a red score doesn't mean that you can't trade it. I just recommend that if you're brand new to options trading, that these are the types of ones that you tend to avoid when you're first starting out. But if you're more experienced, you certainly can go ahead and take the risk, because as you can see, if you're right on the trade and the stock goes down to 75, you still make a pretty nice return, a 97% return in just a few days versus 111% return. We're just simply saying that this strategy here on the right will give you a better risk to reward and less risk. And that's why you have a higher options play score on this specific strategy here on the right. So with that, I hope that we, through this process, I'm showing you guys an example of how to go about utilizing this tool to analyze the trades that you're looking at. And for those of you that are looking to fine tune your strategies, maybe you want to trade a different expiration or a different strike price, you can click on modify. And we call options play we call it options play for a reason, because we want you to be able to play around and explore. Because when you're looking at an option chain, you're able to see a lot of different options, a lot of different expirations, a lot of different strike prices. We wanted to also allow you to do that as well. So if, let's say, you want to change the expirations, you can simply move the expirations by changing the right arrow or the left arrow to move the expirations in one or out one. You can move both strikes on a vertical by just clicking on the right arrow to move the strikes up one or down one. You can make the verticals wider or narrower just by clicking on the width button. This is all designed to allow you to really play around with the different strikes and expirations to see which one's best suited for you. And you can even, for those of you, I saw a few of you in the chat said that you like to sell options going into earnings. And that's certainly another way that you can potentially do this. But if you want to do that, you can use our strategy constructor. So if, let's say, you're bearish on Procter & Gamble going into earnings, but you want to sell some options, you can do a short call vertical instead. Maybe sell some spreads and see exactly what your expected profit and loss is if you sold some options going into earnings. This allows you to really set up any three strategies and actually compare the strategies side by side. So as you can see, even if Procter & Gamble goes absolutely nowhere and stays exactly where it is, if you had sold some options, you'd actually be able to still make money on this particular trade. The only downside to trading credit spreads in an option in going into earnings is that if you're wrong, you're going to be risking substantially more money than what your potential reward is. So as long as you're okay with that skewed risk reward ratio, you can certainly take a look at selling options going into earnings. Very popular strategy as well. Not so much around earnings, but very popular strategy in general is selling credit spreads for income. So with that, I just want to wrap this up. I'll just quickly sum up what I have to say here. Trading earnings can certainly be exciting, but it also can be very risky. So make sure that you utilize the right strategies to minimize your risk by buying calls and puts or spreads. So that allows you to take that directional view and maximize that directional view while limiting your risk. You can certainly sell credit spreads going into earnings, but the risk to reward is kind of the opposite of what you would typically want of earnings. So keep that in mind if you want to sell options going into earnings. And please make sure you use the P&L simulator. It's really useful in helping you better understand how your option prices will get impacted for the different views that you have on the underlying stock. So with that, what I'm going to do is I'm going to open this up for Q&A. Before you can type them into the chat window, any questions that you have, and I'll answer as many questions as I have time for. And I just want to remind everyone, if you download the slides, which we'll send to you with the recording afterwards, we have some important links for you. Specifically, many of you ask us about the webinar recordings. We do them every single week. So we have quite a few of these webinars recorded. The links for them is included in the slides that you will receive after this webinar. So make sure you download the slides. It allows you to view everything that I've shown you here today and allows you to follow along as you watch the videos. We also have links to our daily trade ideas, how to start your subscription to options play, and lastly, follow us on YouTube, because that's going to allow you to automatically get updates for all the webinars that we do. So make sure you do that and click on these links when you sign up for, or when you get the recording from us. So with that, what I'll do is I'll open this up for Q&A, and I will answer as many questions as I have some time for. So I'm inclined to look at the risk side before even considering how much I can make, but that's just me. Absolutely, you should look at both sides. I don't think you should ever look at just one. But the key thing about buying options is that your risk is simply the cost of that option. So you already have that picture as to what your max loss is just based on how much your option costs. And then the potential reward is calculated using the P&L simulator. So great point. Please explain the rating and color circle. So I think I just touched up on kind of how we calculate the option split score. It's really the true risk reward of each strategy. And they're color coded so that you know what's good, what's bad, and what's average. How do you decide on bullish or bearish? I'm not sure what you're referring to in that particular case, but we actually have a specific webinar on how do we determine bullish and bearish, but it's a combination of the 1 month and 6 month trend that we have up here and our technical score. That's how I derive whether I think the stock's going to go higher or lower. And we have a whole webinar specifically on that. It's called how to gain a directional edge. So please, after the webinar, click on the link in the slides that we send you. You'll be able to watch that recording. Chris is asking, how far in front of an earnings announcement do you want to consider buying that call or a put? Very good question. So we generally think that at least 2 to 3 weeks before is kind of your sweet spot, because implied volatilities, generally speaking, isn't very elevated that far out. So you can still pick up some premium or some exposure relatively cheap. And the reason for that a lot of times is because stocks will tend to move in the direction that the market feels that it's going to beat or miss going into earnings. So a lot of times you're actually able to capture that movement before the actual earnings announcement. And many times you might even get out before the earnings announcement. So we usually like to say 2 to 3 weeks before the earnings announcement. That is a good time to consider starting to look at getting into that trade. Great question. What about condors going into earnings? Sure, absolutely. A condor is really just a combination of a call vertical that you're selling for a credit spread and a put vertical that you're selling for a credit spread combined into one. So this is really a strategy for those of you that feel that the markets are not going to go anywhere. So for example, if you think that Procter & Gamble is going to stay exactly where it is and it's not going to move anywhere, you might want to trade an iron condor to do that. Because if an iron condor, as you can see, if the stock stays exactly where it is, you get to keep the money both on the call credit spread and the put credit spread, and you're able to capture that premium on both sides. The only time this doesn't work out is if the stock really does take off and move in one direction or another. As you can see, you're going to lose more money on both sides than the amount of money that you're actually making if the stock stays where it is. So you can use our platform to look at all different types of strategies, including iron condors, if that's what you're looking for. Do Greeks tend to change significantly during earnings season? Not really. The only Greeks themselves don't change. It's the option prices that will change, and the Greeks tell you how much they change by. Delta will change because if the stock moves a lot, gamma, which is the Greek that tells you how much delta changes by. So delta is actually not static. Delta is relatively stable for small moves, but as the stock really moves substantially, delta will actually change as well. So that's really because that the stock has significantly moved. That has really nothing to do with earnings. If a stock moves a lot, delta will change. Other than that, theta and vega are relatively stable and do not change a lot. Joe's asking, where do we find the implied move of a stock on earnings? The best way to estimate the implied move on earnings is really looking at our trading range simulator. So we can use the trading range simulator to get us an idea as far as what the implied move is. So as you can see here on Procter & Gamble, the earnings is on July 26th. So we'll take a look at July 27th, which is the closest earnings date. And here goes the implied move. So 76 to 81 is the implied move. And that's available to you in the trading range simulator, which is the fourth dot from the bottom. Looks like I've got a lot of questions here today. So Juan's asking, what's your opinion on consumer discretionary going into earnings? That's a good question. Let's take a look at consumer discretionary. Consumer discretionary is one of the strongest sectors. As you can see on our ranking system, consumer discretionary is the absolute strongest. It's near its 52-week high. So it certainly didn't scan very high because consumer discretionary certainly was one of these sectors that really lagged the market for quite some time, but kind of really came into its own life over the last Q1 or as Q1 earnings were reported. I would say that I don't necessarily have a strong view on consumer discretionary simply because it had such a strong run. And not a lot in terms of corporate profits came from that. So I don't necessarily have a really strong view on consumer discretionary as much as I do on consumer staples. I think consumer staples is more likely a weaker sector. As you can see, it kind of recovered a little, but I actually think consumer staples may have some more downside. Are slides available? Absolutely. The slides will be sent to you in the replay after we're done here. So we'll send that out about 30 minutes after this webinar. You'll get both the recording of the webinar and the link to the slides. Juan's asking, what are good websites to find estimated price moves up or down on earnings? That's a really good question. I've actually been trying to find that out, and it seems like that's not available for free. There are a few services that provide them, but they're usually a few $100s a month. So it's actually something we've been looking at calculating ourselves because of how expensive that is. But unfortunately, I don't have a website off the top of my mind that I can give you. Given the likelihood of vol crush, would it make sense to look at premium selling strategies? Absolutely. However, the problem with premium selling strategies is that it doesn't give you that directional exposure. So, for example, if let's say you think Procter & Gamble is going to miss on earnings, or I should put it this way: if you expect the stock to not move on earnings, you certainly should consider selling premium. However, if you expect the stock to move, only the debit spread is really going to be able to give you that exposure to that movement. If you sell a credit spread, no matter how far the stock goes in the direction that you expect it to, you're limited to the amount of money that you receive on that credit spread. So here, as you can see on this credit spread, I might make $18 credit, but that doesn't matter if the stock stays where it is or the stock goes up by 10%. I still make the same $18 profit, as you can see. So that's really where you certainly can, but you're not really getting the exposure that you want. Only by buying a call or a put are you really getting that exposure if the stock moves in your direction. Does the options play platform allow you to explore strangles? And absolutely. So if you want to sell a strangle going into earnings, you can certainly select that. Short strangle, short straddle, all available to you here. You can certainly do that. All strategies that you can possibly think of is available to you to look at using options play. What is your definition of standard deviation? 68% of the implied move for any given expiration. I think it's a pretty standard definition of what we consider standard deviation. When will be the best time after earnings to unwind the trade? That's also a really good question. So like I said, we usually want to buy options that are at least 2 to 3 weeks beyond the earnings date. I usually tell users that you unwind the trade whenever you've hit your target price on the underlying stock. It really shouldn't necessarily be based as much on your options as it is on the underlying stock. However, if you have not reached your target on the underlying stock, but the option is now worth 75 to 100% gain on the upside, you certainly want to consider taking profits. And if you've lost 50% of the trade on that you've paid for the option, you certainly want to consider taking losses or cutting your losses. And that's true regardless of whether you're trading earnings or not trading earnings. You want to have money management rules like that, where you take profits if you've made 75 to 100% gains and cut your losses if you've lost about 50% of your premium on that trade. Mickey, thank you very much. So we do have, you can use options play on an iPad. We are currently looking at potentially squeezing some of the functionality on a phone, but again, on the phone would have very limited functionality because we simply can't fit all of these powerful things onto a phone. But you certainly can use it on your iPad. And I do have people who you can use it on a phone. We just don't have an app, but you certainly can look at this on an iPhone. Thank you very much. I really appreciate all the kind words. Does options play automatically consider the high volatility before earnings in its analysis and model? Absolutely. That's exactly what we do. So we look at the implied volatility of the option that you're actually analyzing. So if you're analyzing an expiration that's beyond earnings, it considers that high volatility. If you're looking at a expiration that's prior to expiration, it will factor into the fact that expiration will have lower volatility. So that's already factored into all of our models. Earnings means announcement date, correct? Absolutely. Yep, that's exactly what it means. Long straddle, is it a good idea? Very good question. A lot of people will ask me, well, I don't know which direction it's going to go in, so why don't I just buy a straddle so that I'll take advantage of the stock going higher or lower? This is certainly conceptually a really good idea. However, in practice, this rarely makes sense. So for example, let's take a look at the straddle here. Let's buy the straddle. So Procter & Gamble's trading at 78 bucks. I can buy a $79 straddle, which is basically buying a 79 strike call and buying a 79 strike put. As you can see, that cost me $358, which from a percentage standpoint is actually pretty large. So let's go back to the P&L simulator. Let's see exactly how much does the stock need to move before this strategy becomes profitable. As you can see, the break-even prices on this are $82.58 and $75.42. So you have to ask yourself, do I think Procter & Gamble is going to go up to $82.58 by expiration? And perhaps you want to look at the dates before expiration, right? So here's July 30th, a few days after expirations. As you can see, the stock needs to go about 81 bucks for the strategy to be profitable, and the strategy needs to go below $76 before the strategy is profitable. So you have to ask yourself, do I think the stock's either going to go below 76 or do I think the stock's going to go above 81? Because that's going to help you determine whether or not you should buy the straddle going into earnings. If you think the stock's going to make that big of a move, then certainly you can buy a straddle. But rarely does that actually work out, because usually the straddle costs so much money that the moves simply don't make up for, because when we're talking about this formula here, you want to have that large move overcome the volatility crush and the time decay. But when you buy a straddle, you've effectively doubled the volatility crush and the time decay, because you're losing money on both the call side and the put side, and you have time decay on both the call and the put side. So the move now has to not only be large enough, it now has to be double that amount in order for it to be profitable. And that's why straddles around earnings usually don't work out. Which one of butterfly spread buy versus sell is better in terms of risk or reward? I'm not sure what you mean by that question, because those are two completely different strategies. One is a strategy where you think the stock's going to stay where it is, and the other one's where you think the stock's going to make a big move. So I don't know how you'd go about deciding what in terms of risk or reward, but you would certainly, it's dependent on whether you think the stock's going to stay where it is or if you think the stock's going to move. So that's up to you. As far as, they're just two completely different strategies. You wouldn't really compare one to the other. For Procter & Gamble, what is 822 to 2466 volatility mean on the bottom of the screen? Oh, that just means that's just the range that we think volatility could possibly be within reason for this particular trade. So we don't think Procter & Gamble could possibly be much higher than 24 vol, and we don't think it's really real for Procter & Gamble vol to be lower than 8%. So that's just a range that you can utilize if you think vol is going to go higher or lower. This is a bit more advanced for those of you that have some experience trading with volatility, but it's certainly, I recommend for most of you to kind of leave that alone. The only time we want to move it is right after earnings. You do want to have that come down a little after earnings. Ray's asking, how long will the recordings and slides be available? They're available to you forever. As long as I'll send you the email, you can click on that link at any time. You can view it whenever you'd like. They don't go away. Call versus put, pros and cons. Not sure what that means, because call is a bullish trade, put is a bearish trade. You would only buy a call if you're bullish on a stock, and you'd only buy a put if you're bearish on a stock. For all other purposes, they're exactly the same. Just one's bullish and one's bearish. Ray's asking a really good question. I'm going to come back to that about IV rank and IV percentile. How about using calendar spreads for earnings, short expiration before earnings and long expiration after? Absolutely. That's another strategy. This is a slightly more advanced strategy for people to utilize, to use a calendar or a diagonal. Diagonals usually are a little bit more popular around earnings. So this is, again, a more complicated strategy where you might want to buy a long-term call because you're bullish, but you want to sell a short-term call to take advantage of the collapse in volatility. So this is something that I'm not going to get into today, but certainly a trade that you can analyze using options play. So I want to go back to addressing Ray's question about whether or not we want to include IV rank and IV percentile, and this really goes back to this strategy that let's go back to comparing. So let's say I'm bullish on Procter & Gamble going into earnings. I think it's going to go up to, let's say, 82, I said, a few days after earnings. And let's say, and as you can see, if I had bought this call option and volatility stayed where it is, I make 113% return. But if I actually make volatility come down a little to almost a third, I'm only making 106%. So as you can see, the impact to my P&L from that change in volatility is actually relatively low, even though I just gave it a very large move in terms of volatility. And the point that I'm trying to make here is that volatility is actually a very, very small component of the actual P&L of your trade. Meaning if the stock moves up just a little bit, as you can see, I have a significant impact to my P&L. So delta is by far your largest consideration when you're buying calls and when you're trading any strategy. When we incorporate IV rank and IV percentile, we see a lot of people tend to switch their strategies completely simply because volatility is low or volatility is high. And we simply don't think that that's a really good idea because, for example, if Procter & Gamble currently has a very high implied volatility, we hear from a lot of people, they'll say, oh, it's time to sell credit spreads. However, even though that may be true and you're going to get a slight edge from selling credit spreads, the problem is when you're selling a credit spread, you're not getting the true delta exposure that you're really looking for. And that's really where you're getting most of your profits from. So for example, if I decided instead that I'm going to sell a credit spread, as you can see here, I could have made $217 profit. And even if I normalize it by risking the same amount, let's say I want to risk, let's say $2,000 on this trade. as you can see, even if I normalize this across the same, right? If I had sold the credit spread here, I would only make $1,156 versus making $2,391 if I bought this call. So what I'm trying to say is that you should not switch your strategies just because volatility is high or low, because the actual impact to your strategy is actually just a few percentage points. The difference between high volatility and low volatility is just a few percentage points to your P&L. However, the delta exposure that you have is significantly larger. So your strategy that you choose, whether you trade debit spreads or credit spreads, should not be based on volatility. It should be based on where you think the stock's going to go, because that's really the largest impact to your strategy. And that is why we've shied away from putting IV rank and IV percentile. And I hope I'm not going off course here and confusing some people by going into this more advanced topic here, but it is a question that I get asked a lot is, why don't we have implied volatility, percentile, and rank? And it's really because I see people using the wrong strategy simply because they see that IV rank is high, so they think that I need to sell a credit spread, or IV rank is low, so I'm going to buy a debit spread. When in reality, whether you trade a credit spread or debit spread should really be based on where you think the stock's going to go. Because if you think the stock's going to stay where it is, you're probably better off trading this credit spread. If you think the stock's really going to make a big move, you're probably better off trading this debit spread. Regardless of where vol really is, whether it increases by 100% or decreases by 50%, as you can see, the increases to your percentage P&L is relatively small and minimum compared to even just a small change in the stock price will give you significantly larger gains and losses. So my point is your delta exposure is so large compared to your Vega exposure, yet I see all these people changing their strategies just based on Vega calculations alone. And that's really why I've shied away from using the strategy. Ray, I know that this is kind of a long-winded answer to your question, so I'm happy to answer this question more in detail. If you have specific questions regarding this, you can send me an email at info@optionsplay.com, and I'm happy to kind of delve into a little further as to what I mean by this. I hope that didn't confuse anyone. And is there any more questions regarding anything that I spoke here about today? Albert, thank you very much. Ivan, thank you very much. Raymond, thank you. Irina, thank you. Thank you, everyone, for saying that. Please, if you guys have questions regarding things that I've gone over here today, please email me at info@optionsplay.com. Happy to answer as many questions as possible. Like I said, the slides and the recording is built into the emails that I'll send out in about a half an hour. So please look out for that. If you guys have any feedback on the webinars, both on the topics, or if there's specific topics that you'd like us to cover going forward, we do these webinars for you guys. So please feel free to provide any feedback, provide me with any questions. And I hope to see you guys here next week. I believe we're going to be doing debit spreads next week. So I used to do a webinar on debit versus credit spreads. So now I wanted to do a specific one just on debit spreads. Many of you like to trade them. It's certainly personally one of my favorite strategies, because again, it gives you that true bullish or bearish exposure with limited risk. So we're going to go into that in much more detail next week. And the week after that, we're going to talk about credit spreads. So for those of you that like to sell credit spreads, we'll get much more in depth into selling credit spreads. So Ray, regarding your question about IV rank and IV percentile, I think it's extremely useful to attend both the debit spread and the credit spread ones for those of you that like to trade spreads. So again, thank you very much for joining us this afternoon. I'll send out the email with the recording in about a half an hour, and I'll see you guys next week. Have a great afternoon.